Hello guys, welcome back. In this video we are examining HP, Hewlett-Packard, a company that obviously Warren Buffett likes a lot. He just bought more of it, and it's one of these companies that has actually not really fallen at all, or almost at all, in the last period when the stock market has been pretty much crumbling. You will see in the 5-year chart that we're looking at its highest levels here, so it's still peaking almost, as if nothing has really happened with it. Now that doesn't mean that it is a good buy because it hasn't gone down. It may actually be already overpriced potentially, and so we do want to examine that. Typically speaking, I don't really like buying my stock when it's actually up there, but if it's a good company and if it's doing well and if it's cheap compared to the financials, then I could consider it buying for sure. Consider buying it. So if we take a look at the stock news here, you will see that the second largest US pension actually bought AMD block and sold Berkshire and HP. I found this one to be super interesting here, and this is the second largest American public pension here. The California State Teachers Retirement System increased investments in AMD and SQ, and actually trimmed actually some of their Berkshire and HPQ. This is interesting to me and somehow weird because generally speaking, a company like AMD and SQ were a little bit overpriced, and I still think they are. At least AMD, I examined it recently, it's still overpriced, while Berkshire and HPQ are probably much better in terms of valuation. So I'm a little bit surprised, although, you know, this kind of pension plans are weird getting these days if they even want to be adding cryptocurrency, which is insane. And so, yeah, you can see anything really. So, let's go back and examine the financials. Now, this one is looking at a 7P ratio and a 7.2 price to free cash flow ratio. Very similar, which is something that I like to see, and very low, which is something that I like to see even more. It used to be a little bit more, but now it's still rather low here. 7 and 7, even though the company's price is still elevated. This is great to see. Now, the outstanding shares of the company have been going down tremendously, about 40%. The company has been buying a lot of shares, and still they're able to pay their dividend, which is rather hefty also, 2.2%. And I'm saying hefty compared to the payout ratio, which is rather low here. 16% of its free cash flow, it's very low in terms of the dividend yield. And if we take a look at the dividends tab here, you will see that it has been growing higher and higher every year, and it's very safe based on the payout ratio here in terms of its free cash flow and net income as well. So that's great to see. Now, the company has been increasing top and bottom line, but if you take a look at the total equity here, you will see that it's in the negative. And so it's better, but it's still in the negative. Now, some companies at least kind of like to have a low total equity because it can increase the return on equity, because if you have lower total equity and you are doing better in terms of your net income, your profit, then your return on equity is going to be high, and so you can kind of attract more investors who are just looking at this value without examining the finer details. And so we need to examine what is going on here, and you will see that the debt to equity ratio is negative here, so means that the debt that the company has compared to the equity is negative, meaning that the equity is negative, of course. Okay, so the next thing that we're going to do, of course, is examine the financial statements in a little bit more detail here. Now, we do know that the company's revenue has been increasing 52 billion to 64 almost here, and the net income increasing as well, 2.5 billion to 6.5. So in terms of profitability and revenue, the company seems to be doing rather well. Now, the balance sheet here, you will notice that the total equity has been negative for many years now, and even though it went a little bit better, then it went a little bit worse, and then it went a little bit better again. So it seems to be going up and down a lot. Interesting to see from this company. They seem to be keeping their debt at similar levels and pretty much their operations at similar levels. With their current liabilities, for example, actually you will see here, their current liabilities have been in total like 22 to 29. The assets 10 to 16, it's kind of similar in terms of the increase that you are seeing. And so overall, if you take a look at the total assets, 32 to 38, 36 to 40, they are almost increasing at a similar pace here, almost looking as if the company is trying to keep these in a sort of like balance, in a sort of like balanced manner here, sort of like keep the equilibrium going. Now, remember, this is important, the company has bought a lot of stock. They have bought about 40% of their stock back in the last 5 years, which means that their retained earnings are going to go down. They will have less to pay in terms of dividends because they are buying back shares. But remember that this is also a very good thing, because now your stock is worth more. It's stronger, and 40% stronger. That is because they have actually bought that much. And so this is a great thing for shareholders, and even though the retained earnings are less, the company still makes a lot of free cash flow to comfortably pay all their dividends very, very easily here. So this is great for the company to see, really. So these numbers are looking great, even though the total equity is actually down. This could happen just because the company is buying back a ton of shares, really. Now, and also increasing their debt. They may actually be using some of their debt to buy back shares here. Now, the cash flow statement, you will see that we're looking at operating activities that gets increased here, 6.4 billion lately, with a change in working capital of 1.1 billion here, substantial in terms of inventory. The company has been increasing their inventory like hell here, and their change in working capital is negative, spending cash to increase their net working capital here. Now, the company has been investing as well, as you'll see, and acquiring stuff here, for example, investing in PPE, some capital expenditures. And in terms of financing, you will see here that they're paying back some debt, but also repurchasing common stock. Very important, 6.2 billion. That's very, very hefty, of course, for a company that's like, what, 40 billion in terms of, I believe it's 40 billion. Let me actually just quickly check it here. It's probably like 40 billion in terms of, 41 billion, 42 billion in terms of their market cap. So that's a very large amount of share buybacks, as you can understand, proportionally. And the free cash flow from 3.2 billion to 5.8 has been increasing nicely. The last thing that we want to do, of course, is determine the price to pay for this one, which looks like a great company, but it has to be cheap for us to buy. And so the revenue growth has been 7, 12, pretty much 0 here, -3 and 12. The 5-year average, the 3-year average, 2, 5, and 12. I think I'm gonna go, or 3 that is. I think I'm gonna go somewhere in between again. 3, let's say 3, 5, and let's just go with 8 for this one. The net income margins here, you will see that they are close to like 5 and 10 really. I'm gonna go 5, 7, and 9. And the free cash flow margins again about a 90, 120 here. So I will go like 90, 100, and 110. Annual return of 13%. Let's see what we're getting out of this. We hit calculate. And yeah, as expected, the company is definitely a buy at its current price, even at our low estimates here of revenue growth, just 3% for the next 5 years, and net income margin of 5%, which is less than every year that they have achieved pretty much in terms of the averages. And yeah, this company seems to be pretty awesome in terms of what it is right now. And even though it hasn't dropped at all, and it would be nice if we could get it at a better price, it looks like it's very strong in terms of the financials. I like what I'm seeing here a lot. Of course, remember that you can always become a member of this tool and examine all sorts of companies, including this one, with your own projections here. You can become a Patreon and get full access. You can find a link in the description box below this video. And also you can join our Discord channel. Again, links in the description box below. Thank you for watching this one. I hope you enjoyed the video. Remember to leave a like and subscribe, and I'll see you in the next one. Bye-bye.